Next question. A Limited wishes to raise additional financing of rupees 30 lakhs for meeting its investment plan. So the information is given about a company which is considering to raise 30 lakhs for meeting its investment plan. The company has 6 lakhs in form of retained earning available for the investment purpose. So the company is having an amount of 6 lakhs which can be used for the investment purpose. The following are the further details. So certain further information is provided about the same. Debt equity ratio is 30 is to 70. Means 30% is the debt financing, 70% is equity financing. Cost of debt is 11% before tax up to 3 lakhs and 14% before tax beyond that. So the rate of interest is provided to us for the initial 3 lakhs and after that. EPS is rupees 15. Dividend payout ratio is 70% of the earning. Expected growth rate in the dividend is provided as 10%. P0 is given 90 rupees. Company's tax rate is 30% and shareholders personal tax rate is 20%. Again, this shareholders personal tax rate information will be useful to make the calculation of the cost of retained earning. You are required to 1. Calculate post-tax average cost of additional debt. Calculate the cost of retained earning and cost of equity. Calculate the overall or weighted average cost of capital of additional financing. That is a question. I request all of you to go through the question, please. Dear students, over here, the question is providing the information that say we have funds requirement of 30 lakhs. Information is provided to us regarding optimum capital structure. It has been given to us that say we have 30% as debt financing. Debt financing is rupees 9 lakhs. 30 lakhs into 0.3. And there is equity financing of 70%, that comes to 21 lakhs. Like that information is given. It has been given further that cost of debt at the rate of 11% before tax up to 3 lakhs. So this 9 lakh rupees of the debt financing is having the division. Information is provided to us that for the initial 3 lakhs, rate of interest is 11%. Out of 9 lakhs, 3 lakh rupees will have the rate of interest of 11% and the remaining 6 lakhs will have rate of interest of 14%. That is the way we have been provided with the bifurcation. Okay. Regarding equity financing, we can say the language of the question is very clear that the company has 6 lakh rupees in form of retained earning. So again, this 21 lakhs will have the bifurcation. Certain portion will be say by way of retained earning. Amount of the retained earning is rupees 6 lakhs. And the remaining is new issue of equity share capital. Out of 21 lakhs, 6 lakhs is retained earning and new issue of equity share capital 15 lakhs. That is what say again calculated as balancing figure. So I make a kind of box like this. So this is basically provided to us in terms of the pattern of raising the additional financing. So friends, we have been provided with the information. This is the way we are going to raise the financing. Even though this working does not form part of the answer, however, I wish you write this answer. Heading of this working note is working note number 1, calculation of pattern of raising finance. Please write on this working note. Now I want somebody of you to, that is a give answer for the first question in the chat box. The question says that it's a calculate post-tax average cost of additional debt. Dear students, always remember that say the word post-tax may be given, may not be given. Always we are required to understood. Always we are required to understand the same as post-tax only. One more clarification that I want to give. Cost of debt at the rate of 11%. This before tax may be given, may not be given, but this cost of debt is required to be understood as simple rate of interest only, unless it has been given post-tax cost of debt. So this information which is given is assumed to be post-tax, and whatever the answer that say we are required to compute is understood to be post-tax. Calculate answer of the first question and put your answer in the chat box. So friends, in the first part of the question, we are required to compute the post-tax average cost of additional debt financing. So I request all of you to write down answer along with me. Answer of the first question will be found like this. Cost of debt financing is interest into 1 minus t divided by amount. The question is providing the information. The initial 3 lakhs will have the rate of interest 11%. Additional 6 lakhs will have rate of interest 14%. So this is the total interest. Into 1 minus income tax rate 30%. Whole divided by 3 lakhs plus 6 lakhs. So the numerator becomes the cost, and in the division we will have the amount. So it is 33,000 plus 84,000 whole into 0.7 divided by 3 plus 6, that comes to 9 lakhs. So what will happen? 33,000 plus 84,000 is 1,17,000 into 0.7, 81,900 divided by 9 lakhs into 100. That comes to 9.1%. This is the way KD is calculated. Instead of making calculation like this, a student may compute the answer. Since there is no premium, discount, everything, so student can calculate the answer like this. 11% into 1 minus 0.3, 14% into 1 minus 0.3 once again. So 11 into 0.7, that comes to 7.7. Again 14 into 0.7, that comes to 9.8. Okay, so this is what's the cost. Then amount. Initial 3 lakhs, next 6 lakhs. So total is 9 lakhs. So weight is 1 by 3, 2 by 3, 7.7 divided by 3. That comes to 2.5667. 9.8 into 2 divided by 3. That comes to 6.5333. So we just have to add both of them. 2.567 plus 6.5333, that comes to 9.1. This is also the way you can calculate the answer. Now, second part of the question. Calculate the cost of retained earning, and so you are required to calculate the cost of equity. Dear students, over here, in this question we have been provided with the shareholders percent tax rate. So of course we understand that, say, first of all we are required to calculate cost of equity, and then we are required to compute the cost of retained earning. That is the sequence in which we have to do answer. That is the first thing. Second thing that, say, we understand is the question is providing the information about the earning per share and dividend payout ratio. You can very well understand that, say, the earning per share is rupees 15 and dividend payout ratio is 0.7. So the dividend per share is 10 rupee 50 paise. What I want to tell you, listen carefully. Now, whether this earning per share which is given to us in the question is of year 0 or it is of the first year end, for that, so the clarification is not made. If it is of year 0, then in that case 10 rupee 50 paise is considered to be D0. And if at all the information is given about this earning per share at the end of the first year, then in that case the D1 is again 10.50. What I want to tell you is that, say, what would be the expected or projected dividend is, say, depending upon that, say, this information is about year 0 or year 1. If it is of year 0, then this is D0, and then we will add growth rate to the same to compute the D1. That is what we understand. So friends, over here, unfortunately, say, number of times we are having the answers in which this is assumed to be of year 0 and sometimes it is assumed to be of year 1. So you also have to make your own assumption for the purpose of calculating answer. In this question we are assuming it to be year 0 and accordingly we are doing answer. So answer for the second part of the question. Calculation of cost of retained earning, comma, cost of equity. In that write down working note number 1, calculation of D0. It is EPS of year 0 into dividend payout ratio. So 15 into 0.7, that comes to rupees 10.5. That is the way D0 is calculated. Working note number 2, calculation of D1. It is D0 into 1 plus C. Just paid dividend is 10.5 and growth rate is 10%. So 10.50 into 1.10, because the growth rate is 10%. 11.55. That is the way the D1 is calculated. Next, calculation of cost of equity. It is D1 upon P0 plus growth rate. D1 is 11 rupee 55 paise divided by P0 is 90 plus growth rate 0.10. So d1 upon p0 plus growth rate, with that, so the cost of equity will be found. 11.55 upon 90. So 0.1283 plus 0.10. So 0.2283. That is 22.83. Please add on K. Next is calculation of KR. In the write down K into 1 minus percent tax rate. K is 22.83 into 1 minus 0.20. So 22.83 into 0.8, 18.26. That is the way the KR, cost of retained earning, is found. Next, calculation of the overall or weighted average cost of additional finance. This after tax word is of no use because it is always assumed that we have to compute on the after tax basis. So write down answer. Calculation of weighted average cost of capital of additional finance. Column number 1 will be source of finance. Column number 2 will be amount. Column number 3 will be weight or proportion. Next column will be cost of capital. And last will be weight or cost of capital. This is the way we are supposed to do it. Try to do answer and put your answer in the chat box. So column number 1, source of finance, in that it is equity share capital. Next is a retained earning. And the last is debt financing. Amount of the equity share capital is 21 lakhs. Retained earning is 6 lakhs. And so the amount of the debt financing will be 9 lakhs. I'm sorry, this is 15 lakhs. So the total is going to be 30 lakhs. So 15 upon 30, that comes to 0.50. 6 upon 30, 0.20. 9 upon 30, that comes to 0.30. And the total is of course 1. Cost of equity share capital is 22.83. Cost of retained earning is 18.26. And cost of debt financing is 9.1. So like that we'll have the cost like this. So it is 22.83 into 0.5, 11.415. 0.2 into 18.26. 3.65. 0.3 into 9.1. 2.73. So it is weighted average cost of capital. 11.415 plus 3.65 plus 2.73 is 17.795. This is the way weighted average or overall cost of capital is found. Please write down answer. So friends, based on this working, we understand that say whatever this 30 lakh rupees of the additional investment that say the company is going to make should give at least the return of 17.795 percentage. That is what we understand. Over here, dear students, you can very well understand, even if the third question is asked upon, it is necessary that we are doing the first question, we are doing the second question, and only after that we can do the third question. That is the way we are supposed to do the answer of the question. So this is the way weighted average cost of capital is calculated.